So how can we use making a pension contribution save you capital gains tax? Well, it can, and here's how. So in the 2016 budget, a significant announcement was made that changed mainstream capital gains tax. The rate has been reduced from 18% to 10% for basic rate taxpayers, and from 28% to 20% for high rate taxpayers with chargeable gains. Except, and there's always an exception, chargeable gains relating to the disposal of residential property do not qualify for the reduced rate, unless of course it's your primary residence. So the 18 and the 28% rate still applies, unfortunately. So let's look at an example of how you can save capital gains tax by making a pension contribution. In 2016-17 tax year, let's say you have earnings of £45,000 and you've just sold some shares that you own that are worth £40,000, and after capital gains tax allowance of £11,100, you have a taxable gain of say £10,000. So you're clearly a higher rate taxpayer. So what's the answer? As I said before, capital gains is now taxed at 10% for non and basic rate taxpayers, and 20% for higher rate taxpayers and additional rate taxpayers. When the gain is calculated, it's added to your total income. So if any of the gain is within your basic rate tax band, it's taxed at 10%, and any gain in the higher rate bracket is taxed at 20%. The individual's basic rate band is increased by the amount of any grossed up personal pension contribution. So let's say you make a personal pension contribution of £8,000 net, which is £10,000 gross after the tax relief. The pension contribution will effectively pull all the income subject to higher rates of tax into your basic rate tax band. Put simply, instead of spending the money and investing the share sale proceeds into a pension, your tax bill will be reduced and no higher rate tax will be due. Not to mention the fact that the investment cost of £8,000 will leave you with £10,000 in your pension pot. The gross contribution of £10,000 has not only saved you tax, but it also received tax relief of an additional £2,000. So we need to follow these 4 steps. First of all, identify earnings in the higher rate tax band, calculate the taxable gain, calculate the contribution needed to move some or all of the gain into the basic rate tax band, and finally make the personal pension contribution in the tax year in which the capital gain is to be taxed. So investing in pensions often gets a bad press, but as you can see from this simple example, they can prove to be very effective. To make sure you're not making any mistakes, it's always advisable to seek professional advice when you're looking to mitigate any capital gains. So my name is Martin Dodd, and I look forward to talking to you again on my next video. See you on the other side.